Good morning, everyone, and welcome to Tax Hacks 2020 on this Saturday morning. Thank you so much for joining in. So today we have specifically invited a special guest, Mr. Vijayanush Narasimhan, VJ. He is the CFO of CISCO, and he specially took out time to be our guest and enlighten us on investments and saving taxes, creating wealth over a period of time. And we have our own very dear Mr. Dipen, Head of Equities Research and Strategic Marketing. So good morning, gentlemen, and welcome to the workshop. So
good morning.
The whole idea of doing this workshop was basically to handhold our audience to save taxes. Now that we are coming closer to tax season, we all will be compelled to submit our investment proofs so that we can save as much taxes as possible. So we thought that this is the right time wherein we can handhold them, educate them, and guide them on various avenues of taxation and various avenues of saving taxes, which not only helps you in saving taxes in a financial year, but also helps you in creating a wealth over a period of time. So over to you, gentlemen.
All right. Good morning, Vijay. Good to have you on this webinar.
Thanks, Dipen. Yeah, thanks, Dipen. Thanks, Pratibha. It's a pleasure, actually.
Yeah, so maybe a good place to start before we dive into the presentation that we have to share with our audience. A good place to start might be that you make some comments on the common savings / long-term wealth accumulation / tax agonies of the average well-heeled employee in India. And maybe that's a good place to start. The problem statement is a relevant place to start when we have an alleged solution over the next hour or so in place. And I say alleged solution, be prepared to get grilled, hopefully by some of your own workers at CISCO. I think we should be seeing quite a few of them. So here is their opportunity to grill you rather than the other way around.
Yeah.
Okay, but let's start with the problem statement, Vijay.
Sure. Thanks, Dipen, once more. Thanks, Pratibha. It's a pleasure to be on this quick Saturday catch-up, if I can call it, on some of the tax hacks that we're looking at. I think whenever all of us, right, during our younger days, when we start our career, let's say in the early 20s and so on, we really don't think about our future, right? You just want to get into your job. At least the new gen that I see, they want to buy a new phone. It should be the iPhone X12 or something like that. You need to have a new car, preferably something that has got an automatic, option to drive. Everybody wants a new home. I think that's the sense of achievement that they have. You can go back and claim that they have really arrived, right? So those are 3-4 things that they want to achieve. But what really we don't give a perspective to is what Chanakya had once said, right? If you go to the Arthashastra, he actually said, you look at your life as 3 aspects: what you're living for today, what you're living for tomorrow, and what you're living for the past, right? Essentially, what you're living for today is what you need to expend. So he says not more than 30 to 40% of your money should be spending for what you're living today, right? And almost 30 to 40%. So it's basically split it into 3. 1/3 of it should be for something that you will do for the future. Essentially, that's what you call as retirement, or a time when nobody is with you. Whomever you are invested through your life is not with you, and that's when the only thing that can support you is this financial burden, rather financial assets that you create and the wealth that you're talking about. And 1/3 of it is for the past, essentially for people who helped you come through in your life, how you are going to give back, what is that you do to the society. So these 3 aspects have always been in my mind when I looked at investment, right? From a point of view of what we do between these 3 aspects. So the conundrum for any normal man is how do we bifurcate this? So 133% nobody thinks about future. Let's see what happens. Let me look for the new job so that I can upgrade my phone, or I can look at buying a bigger house. So those kind of things play in your mind. And generally, tax and the investment is only looked at between the month of February and March, right? Let's say January, February, March, if I can be conservative, right? So, oh, I have to file my return. My employer is asking me to submit some proofs. Let me go around and see what I can do. So it's not a like well thought through process. It's something that I can pick up. And at that point in time, there will be some agents walking around in the office. So you call them, if I do this, can I get some tax benefit, right? So that's the short term, and nobody thinks about it as a long term. How do I invest for the future? If everybody starts setting aside some money very early in your life, the compounding impact is something that is completely ignored, right? If you want to look at from a wealth standpoint. So I think these are the few aspects that a common man can think through early in his career. So there is a story that Warren Buffett spoke about. So he had $1 million to be given to one of his nieces. So there were two of them. So he asked one, what do you want? So one said, give me $1 million in cash. Another said, give me $1 million worth of, let's say, some good stock, right? So he invested in Coca-Cola. That's what I'm given to understand. Today, the person whom he gave $1 million to is nowhere, but the person to whom he gave $1 million worth of Coca-Cola stock is really wealthy, right? I mean, this goes back to my own experience in 2005 when I bought a Bullet, right? Iker automobiles. So I spent 1 lakh for buying a Royal Enfield. Had I invested that same 1 lakh into Iker stock, I could have, had a factory of bullets, right? That's the real way of looking at it. So, that's the conundrum that you are always caught up with. So I think it's a right way to put it. Where do you invest? Can you start early? And that's this whole presentation all about.
So I'm happy you said this, Vijay, because it's a value, it's a sanskar, it's a wiring that we need to have, and we've always had it as Indians, and we seem to be losing this very desirable sanskar. So there are good and bad sanskaras, but this is one of those good sanskaras which has been coming from time immemorial. And to be able to split the Kal Chakra into 3 parts and then plan your finances accordingly, this should be hardwired into us. But it isn't, and we are kind of losing our grip over this ancient values, this ancient sanskara. So there is this wiring, there is this sanskara thing in the community of, if I can use a Hindi word here, the Kanjus people who are tax hacks. Okay. They hack away at taxes, and that's how they save money in the short term. They put it away for the long term by saving it in the short term, and then it compounds. And the younger you have, the longer runway you have to compound it. So all of you guys who are 45 plus compared to the guys who are 25, it's actually the 25-year-olds that I want to be talking to today on the virtues of long-term investing, on the virtues of hacking your taxes, and the virtues of compounding, because that's the ammunition available to you. Okay. So you should be thinking, tax hacks should be thinking in the last 2 of the 3 Kal Chakra terms, so to say, short term, medium term, long term. So the 7 to 15 years kind of money that you want to accumulate is typically higher ticket size, whether it's for buying a home. You mentioned this, Vijay. Education of child, self, spouse. You might want to go to a foreign university, send your daughter to, to NYU Stern, for example. Or maybe you want to have a second child. Your family needs support, and in the long term, which is like 15 years plus, you will run into issues like your children's marriage. You'll say, what, I haven't thought of this. But you need to have that view. The great businesses and the great lives are built on a long vision and view of things. So you might need a retirement corpus. You may need to start up a new business. You need to live well. You should be thinking, all those long-term money requirements. And when you save taxes, when you hack away at taxes, medium-term and short-term spends, I think cars are available now on installment. Vacations are available on installment. So the short-term doesn't matter. You can splurge, but you should hold back your splurging and save for medium to long-term. Again, the principle here is the principle of deferred gratification. When you defer your spend, you can spend more. That's the wiring of a conjuice. That's the wiring of a tax hack. And
yeah, see, go ahead.
So it's this wiring which helps you compound stupidly when you move forward in time. And it is stupid compounding. I mean, you mentioned Coke, you mentioned iSure. I come from the city of Calcutta, and I was tracking Shri Cement for the longest time. I've seen their stocks trade at 18 and 20 and 30 and 50 and 100 rupees. They are like at 20,000 plus today. They're 24,000 something if I'm not mistaken. This is what 30 years of investing can do, but in the right company. Okay.
Yeah, what I was also saying is, if you look at the kind of um, discussions that are happening in the younger generation today, right? whatever you spoke of is actually life, right? So your financial support system and your decisions should be such that you can support life, right? Today it's the other way around. You are aligning your life to what financial systems are there, right? Let me give you an example. So when our parents were married, they really did not plan saying, okay, let me have kids 5 years later, right? They said, I'm already setting aside some money and I'm investing into the child, let me have it. Today the younger generation is different. They are saying, oh, child means it's an expense, I will not be having the money to manage it. So all of it is because they're differing their decisions, right? So the life decision should not be dependent on financials. I think financials should be planned towards how to achieve life decisions, right? That's a slight different way of thinking about it.
Yeah, I take the point. So let's get on to the journey of hacking taxes. Okay, Pratibha, next slide. So this is the toolkit. These are the weapons you have. Okay, and of course there's a long list of weapons. India is a complicated country with lots and lots of regulations and qualifications and clauses and sub clauses in the tax laws. But mota, this is what it looks like. You want to save tax and create wealth. That's your job as a tax hack. And in the medium to long term, particularly long term, which is why I've put an underline below long term there. So the big 8 products, the super 8 for saving taxes, ELSS, tax saving FD, health insurance, life insurance, they save taxes, but they are actually both have savings as well as protection flavors. These are different from traditional saving products. They also have protection, and these are must-haves in today's day and time, given the rising cost of health insurance and the increasing unpredictability of life. Okay, then of course the employees provident fund, which all of us crib about when we get our monthly payouts, monthly salary paychecks. Arey, mera itna employee provident fund cut jata hai, yaar, I wish I had that money in hand. You'll be surprised, I'm 53. I'm actually very happy that EPF was deducted throughout my career. If you ask me in retrospect, I think they should have deducted more. Okay, public provident fund. I've just completed 15 years of savings. I started late in the PPF game. I've actually extended my PPF account for another 5 years, and inshallah I will extend it for another 5 years. Sovereign gold bonds. Well, there is a bit here as well, and the national pension scheme system. So NPS is underlined and in bold because we're going to talk about that in detail. Now, all these instruments, Vijay, get diverted into one or more asset classes. Okay. So there is equity, there is bank deposit, there is government debt, there is corporate debt, there is gold, of course. I think, Pratibha, you've forgotten that bit on the sovereign gold bonds bit. And of course, there is a protection corpus that the insurance companies, whether the health or insurers, take you on. So this is the big two. These are the big guns, and this is the kind of bullets they use. Okay. Any high level comment?
Yeah. So I think what Pratibha mentioned, sovereign gold bonds, they are also a kind of a government debt. They're only pegged at a gold thing. So to that extent, may not be the asset class that is mentioned here, so I think it's covered to that extent.
Right.
The important part of it is we have to look at the horizon and the goal that we have, right? How you can use this ammunition, right? So I think those are the aspects that we will talk about. That's the feedback.
So let's see the ammunition. Next slide, Pratibha. All right. So before we get into the ammunition, please remember now the pitch is now cleared a bit. So we were playing test cricket so far, but now you have a 2020 option as well. Okay, I can't put it better than this. So there was the old regime which works for the tax. And then the new regime, you have lower rates. You can save money on taxes, but no hacking allowed now. There are no exemptions. There are no fine clauses to chase. No instrument specific exemptions and deductions from your taxable income. You want to keep things simple, you follow the third column there in the table. But if you are a tax hack, trust me, the old system works, and it works nicely. So this is what we are. So I don't subscribe to the 2020 principle, the new regime. I'm still an old-fashioned test cricketer. Forget even one-dayers. Okay, it's boring, but you know what, it pays off in the long run. Most boring
so
things are rock solid in the long run.
exactly.
Yeah.
So the point I had was, if you look at the old rates, they are pushing you to make these investments, right? Like a point I made about youngsters who are there, they only look for these people in January, February, March when the returns are due.
Right.
So this is a way of enforcing some amount of investment point of view and lifestyle, right? Because investment needs to be done before you actually spend, right? Today what is
Right.
happening is whatever is left out of spending is what is looked at as investment. So I think savings is income minus expenses. Actually you should look at it from point of view of determining the savings first and then expending, right? I think this particular 2020 match that you are referring to, Dipen, is the formula put the other way around. This is very
Right.
beneficial for the government. Please remember that. More you spend, it will give GST returns. It is good for the economy and all of that. But end of the day, the way the Indian economy is aligned, the social security system is very poor, right? I think in whatever sense you may say, you cannot undermine the fact that you are not a US citizen or you are not some European citizen,
Right.
where once you have a child, the government will come and say, oh, thanks for creating a baby here, right? It's not going to be that. So you have to fend for yourself. So if that the initiative of the government to help us do that was in the old tax rate system, if you look at it net to net, there is not much of a difference in terms of tax what you will save and the kind of investment that you will do if you don't do this. But it's important that the old tax rate is what I also prescribe to. And any of my clients ask me, any of my friends ask me, I say I don't even understand the new tax regime. As simple as that.
Right. So the beauty in the old tax regime is that it offers you a way to save taxes via incentivizing the good and virtuous life. The good and virtuous life is about well-being. It is about spending adequately on things like education, house rent. It is about donating or spending on your own education. It is about taking up a home loan and building your house for the future, your nest for the future. Or it is about short and medium-term savings like ELSS, FD, NSC, and so on, or long-term savings, and so on. So these are all virtuous behaviors which don't look very sexy right now, but which pay off in the long run for you. That's the idea. Okay, Pratibha, let's look at the bullets now. What are the tax hacking bullets or weapons actually available? Yes? Are we stuck?
Are you able to see ELSS?
No, we are not. I think
Not
your
yet.
presentation.
Are we able to?
Okay, so maybe you need to load it again or something. I'm not sure. You want me to run it from my comp?
Now?
Not yet. I think you
Are
just
you
need
able
to.
to see it?
No. So my suggestion is you stop sharing it and then start sharing it all over again. Maybe that's a better way to do things.
Visible?
Dipen,
Okay.
in your view, how has been the adoption of the new tax scheme? Have you seen more people opting for it, or what has been the view?
So it's actually a direct function of how you are wired. If you are wired with the sanskaras that we have been talking about, yeah, Pratibha is online now. So let me just finish this point. So if you are aligned, if you are a test cricketer at heart, let me continue with the analogy that we started this with. If you are a test cricketer at heart, I suspect you will play 1 or 2 years of 2020 or one day, call it whatever you will, but you will eventually figure out that the long-term way to live life is a better life. You will come back. But what am I observing in the field? Well, it's anecdotal. The sample size is small, but from whatever I can see, I think most people are not making the switch. Most people are happy to be where they are. But that's my sample. I could be wrong. It could be sampling error.
Oh, okay.
But
So I
so
think
you are in a position where as
your sample and mine is more or less the same, right? I'm seeing most of them opting for the older scheme itself. Not many people shifting onto the newer regime.
yeah. So, okay, on to the weapons, and I think ELSS is well known to everyone. I think the audience is reasonably literate. Equity-linked saving schemes of mutual funds, which are subject to market risk, invest up to 80% of the corpus into equities. You have a 3-year lock-in, so you won't do a jittery exit. Evidence over the past few decades tells us that equities do generate very good returns over the longer term. So don't panic if markets go down and up. We've seen that happen in March, April this year. It happened in 2008-9 as well. It happened in 2000 as well, and so on and so forth. The interesting thing about this is that the exemption from your taxable income goes into the ATC umbrella, which has got 1.5 lakhs. So this is one of the instruments that is available under the ATC umbrella. Very interesting bit. Even the redemption profits are tax-free up to 1 lakh rupees per annum. This is a lesser known and lucrative aspect of ELSS. So if you are the ELSS types, just keep on parking money into ELSS, and after 3 years, when you redeem that money, it will still be that redemption will be tax-free up to a profit of 1 lakh rupees per annum. So you can actually time and size the redemption in case you want the liquidity. Otherwise, just let it multiply. A whole lot of ELSS funds have done brilliantly, right? So this looks like a no-brainer. It's simple, straightforward, but it's equity.
It's equity, and you're investing into some of the markets which are the high growth, right? If in India you look at it, we are a pretty well-performing stock market over the last few years, and the prospects are also very good, right? So right now it's burning high, so maybe we should look at it some other time. But definitely, if you're looking at a longer term, anyway, the lock-in period is 3 years, right? So this is the one that you can use for your car, vacation, and those kind of the splurge that you are calling about, right?
Because you keep on getting liquidity back from time to time.
Exactly.
Yeah. If you want to, that is. Of course, if things are going fine and you say, okay, let's push off that car purchase.
Yeah.
Okay, Pratibha. So then you have no, not yet happening, Pratibha. So something's wrong. So there we go. Tax saving FDs. So this is actually a very, very simple thing. It's 100% safe, but you don't get great returns here. You get that ATC benefit. Among the debt instruments, this has got the shortest lock-in, which is 5 years. Equity ELSS has got a 3-year lock-in. This also gets under the ATC umbrella. Now you'll say, how many things do I put under that 1.5 lakh umbrella? So that's why we have NPS, and we'll come to that part later. But keep one thing in mind, that earnings on fixed deposits are taxable. Look at that 5th point or the second last point there. So you can choose a monthly, quarterly, yearly interest payout, whatever you want. But all the earnings here are taxable. It's 100% safe. Your money is in a bank, which is why you'll get awfully low returns, especially of late. I can't think of too many good banks which are giving more than 6% or something on a tax saving FD. Right?
Yeah, the higher that return, then the goodness also reduces, right? So you have cases where some banks went belly up. But see, this is more for people, if you ask me, who want a fixed kind of a return, who are looking at moderate returns, right? Even if you look at a 5.5%, you're going to pay a 30% tax on it. So essentially, your returns are anywhere between 3.5% to 4%. That's what I was telling Pratibha also.
Do you really want to do that?
Yeah, do you really want to do that? A 4% is something, which is not something that even your inflation will be able to manage, right? Yeah, essentially, you're losing the value of your money every year.
Yeah, it's there, but I don't think it's going to be used by too many people, except for the ones who want to say, okay, I don't want to take any chances, like that. So, okay, Pratibha, next option. I guess something's wrong. We are moving a little too slowly on the slides, Pratibha. You need to fix something at your end.
Seems like a diag. We are already on health insurance page, if you're able to see it.
No, it's not refreshing here,
No, it's
and it's not refreshing. And maybe there's a better way to do this. I don't know how we can do this, but try again and let me know.
Not yet.
No, not yet. So something seriously wrong. Or can I share my screen, or how do we do this? So maybe Shyam can help. Shyam, if you're online, can you make me presenter? And I'm happy to take this forward. Yeah. Yeah, there we go. So I'm okay to do this. I don't know if you can see my screen now.
Yeah, we can see your screen. Maybe you
Sorry,
should
it's
be
a
on.
yeah. Does this
Yeah,
work?
yeah.
Yeah, very good. So that happened in a jiffy. I'm impressed. Okay, right. So the thing is that, okay, so Vijay, I hope you can see this now, right?
Yes, I can see it. Yes.
Excellent. So health insurance is the other tax hacking instrument, and a small premium every year entitles you to substantial health cover. Now, there are many product variants. We're not discussing the finer details. And you need to start when you are young. You know, there's no waiting period, lower chances of claim rejections. And the important thing here is now, and you should say this to all your employees and co-workers at Cisco as well, you need to buy health insurance even if you have employer cover. This is very important. One, you will get deduction from taxable income of up to 25,000 rupees premium, and you can take this up to 50,000 for senior citizens and so on. So that's 80D is the section. This is a protection product with tax benefits. So the savings impact comes because of, in case you incur a health incident, then the large payout, 2 lakhs, 3 lakhs, 5 lakhs, 10 lakhs, 20 lakhs. I don't know. Healthcare is costly now. All the hospital stocks are running away, and you know why, right? So so this is
See,
something that is actually to save you
there
money.
is so much of unpredictability, right, in our life. Right? You look at it. Um, for example, a lot of my acquaintances have. I'm hearing a lot of cancer cases recently, right? In
Yes.
the last so many years, I had this cancer. And, people fighting. It's very demanding physically, mentally. Even you have to get yourself to a very spiritual level to actually go through all of this. But
Yes.
if you don't have the financial cover, right, everything else becomes immaterial. Then there was a friend of mine. It's a very sad story though. He had a very serious kidney issue, and he used to undergo dialysis every 2-3 days and so on. Right.
Okay.
Finally, the real thing that hit him is these dialysis cost anywhere between 3,000 to 4,000 every day. Right. If you have to do this like 3-4 times a week,
If you
yeah,
don't
where
have
is the cover? Where is the cover? He really didn't have a cover because he was expecting life will be normal.
that's all.
He finally passed away at the age of 36, 37, and that was because of the financial pressure that he could not undergo. Right. So I think we all take our lives as something that is stable and nothing's going to happen to us. It's all something that will happen to somebody else. Right.
No,
So
yeah,
please
I think the
don't be in
problem,
that.
this is scary stuff, and I think what you're telling me is, you realize how valuable an umbrella is only when it rains.
Yes, yes. And
If,
you have to go through the other pressures. If you have this covered, I think it will help you to go through the other ones much better. Right.
yeah.
So don't undermine the requirement for a health insurance. I mean, whoever is on this show, please make sure you are covered beyond, the cover that your corporate or company is giving you. Right. Be it Cisco or whichever company you are working for. But it's important that you take a health cover for yourself and your family, immediate family, on priority.
Okay. So then you have, of course, like health insurance, you have life insurance, and if you want to add in, if you don't want to buy a term plan, which is pure protection, as the second point says, you can buy an endowment or a savings plan, which gives you protection plus savings. So you get some guaranteed returns at the end of the insured period. And of course, you can take it to the next step, buy a ULIP, which means you get protection plus you get savings, but on the savings you get market linked returns. So this is a more modern format of endowment plans, and it's called a unit-linked insurance plan. Again, this is cheaper to start when you are young, and of course, the compounding window you get is long. Here too, the ATC umbrella limit of 1.5 lakh applies. This is a very popular product, and after the first 2 or 3 years, it begins to look very, very attractive in terms of the cover that you have for the premiums that you are paying and the kind of savings and returns that you get on your ULIPs.
Correct. And if you are looking at investing on the other bullets and ammunition, then a pure protection is good enough, right? So, but if you want to do it on an overall basis,
yes,
yeah,
yes. So
because
life comes very cheap. Sorry.
yeah, it comes very cheap. I think all these ads that are giving today are saying 1 rupee per day for every day of insurance for close to 1 lakh. So something like that. It's very cheap. And if you are covered yourself in all the other ammunition, my recommendation would go for a term plan. But ULIP is also a pretty, innovative kind of investment that you can look at.
Fair enough.
Okay, so PPF, EPF, I think these are compulsory. I think if there is anybody out there in the audience who has not opened a PPF account, okay, let me pitch my bank here. You can open a PPF account live with HDFC Bank. And I'm sure all your employers are doing you the unpleasant favor every month of deducting a bit of your salary and putting it into the employee's provident fund, what we call the EPF or just the PF. Okay, I would call it PF, but then Pratibha thinks it's EPF or whatever. So both of these are must-haves, and both of these again are under the ATC umbrella. You get fixed returns. Sometimes the interest rates are tweaked a bit. EPF still gives you, I think that 8.5 Pratibha would have changed now, but PPF was revised from when I started. It used to be as high as 9% and tax-free.
Yes.
Can you?
Yes.
Can you believe that? And it's EEE. It's exempt when you put in the money. It's exempt when the accrual happens. It's exempt when you pull it out. It's crazy. Both of these. So these are must-haves. These are compulsory. Look, co-tax hackers. If you are not doing these two, then I'm not friends with you. It's as simple as that. And you will probably be doing EPF inadvertently, involuntarily. But PPF, open that account with HDFC Bank right now. It's like that. Or any other bank. Okay, frankly. I don't think there's too much of an argument here, Vijay.
Yeah, I think, let me tell you that 15 years of compounding that we undermine, it actually can give you real creation of wealth.
Crazy.
Nowhere in the world will you get a government scheme that assures you a 7% return or a 8+% return, right? So you have economies where if you invest, they charge you money, right?
Yeah.
Saying, there is a negative interest regime. But India is a great country where you can actually grow wealth like this on a periodic basis.
And it
Again,
happens
this is
subconsciously, a little money just gets shuffled away every month, every year.
Exactly.
And after 20
And
years, you say,
you look at PPF, the demand is not too high. You can even start with something like 500 rupees per annum, right? 500 rupees per annum. It's
that's
not
absurd.
even a kind of a, yeah. So how we the 500 rupees we spend on maybe a pizza perhaps, right? So things like this needs to be thought through, how we can make our life much better. And if this is set aside, the government is very clear that even if you go bankrupt, I don't know if you know, Dipen, even if you go bankrupt, no company can actually come and take your PPF money.
What are you
right?
saying?
Yes, wow. It's a complete cover. It is actually an insolvency cover for you. So even if your PPF money, a large part of your wealth, so very simply, Vijay Mallya went bankrupt, he will still be given his PPF money back. Right.
Well,
so,
let's not get started on Mr. Mallya, but yes, I take the point.
Right. So what I'm trying to say is it's a very small thing. You can actually look at it like investing for your children as well, right? So there is a minor kind of a PPF where you can set aside some money and you can withdraw it at the time of your child's, like you said, you want to send somebody to New York, Yale University or whatever. So those are things that can really work. 7% is phenomenal. I expect those interest rates could change. It could actually get even.
But they'll still be higher than the benchmark rates. They'll still be better than the tax-saving FD rates or nonsense like that.
Definitely. And let me, like your point that you made.
No, and post-tax.
Go ahead.
So the post-tax numbers will look even better. The pre-tax numbers are higher, and this is tax-free, so the post-tax numbers will be even higher. I mean, what are we talking about? This is a no-brainer. Next slide. Okay, sovereign gold bonds. So this is a relatively new instrument that is available to people. Now, for those of you who are gold lovers, and even if you're not, my view on gold is that I don't think it's a great asset to invest in an absolute sense, but it has done phenomenally well for our parents, particularly our mothers. And I think you just need to have a contra hedge on gold. So anywhere between 5 to 15% of your wealth, it's a good idea to put in gold just in case the rest of your wealth blows up for whatever reason. Those are the times when gold shoots through the roof. So you have a contra hedge, you're hedging your investments by doing this. Okay, that's the only reason I'm fascinated with gold. The beauty on the SGB bit is that apart from the gold ride, you get a 2.5% interest payout by the government, and the appreciation that you will make eventually on the gold bonds on redemption will qualify for capital gains tax exemption if it is held till maturity. I think that's phenomenal. You will have to pay some capital gains on physical gold investments, but on the bond you don't. Plus you get 2.5% every year. Wow.
And two other points I want to talk about in SGB is these SGBs are tradable in secondary market, right? So essentially, what happens is sometimes these bonds are through certain demat accounts, maybe through HDFC or wherever. If you can go, you can actually buy these SGBs. Sometimes they are traded at 10% discount to market rate. So it's a
Fantastic.
99. So 99 gram, 99% gold at 10% discount to market rate, giving you a hedge of a tax benefit over 7 to 8 years, plus 2.5% every year into 8 is 20% of your return is back, right? So
Okay.
you cannot undermine the impact, and gold is a great investment for investing against inflation, right? When there is going to be a downturn every 7-8 years, gold is the one that's going to go up, right?
Yeah, so
So
this building a portfolio with a little bit of gold is like creating a cricket team, and you have some funny guy down the batting order. Your whole portfolio is like collapsing, and then suddenly, you're like, if I don't know if you remember the match against Zimbabwe way back in '83, you're 17 for 5, and in comes Kapil Dev, and nobody thinks he's a frontline batsman, and that's when the
exactly,
gold go through the roof, and he hit that
correct.
175 not out. What a knock, yes. So I know
Yeah,
exactly what.
and this is pegged. So this is not one more aspect is this is not physical gold. There is no making charge. There is no wastage charges. This is specifically given by the government. It's completely sovereign. It's confirmed that there is no issue on the risk around here. And also this is paperless. You can carry it with you wherever in your demat account. You don't need to worry about it. Right?
Super. Yeah. So Vijay, this is and that thing about sometimes finding it in the secondary market for a good discount. We should be swooping down on those discounted offers like vultures. Your advice today on this matter, I can assure you, is worth its weight in gold.
Thank you.
All right. So and just give me a sec. Yeah. So there we are. Oh, and this is the star of the afternoon. This is the least known and the most powerful weapon for us tax hacks. The first thing is that you can keep on accumulating and compounding all the way till age 60. Now, for those of you who are 20 something, you will say age 60, and you'll be surprised. When you're 35, you will understand what this means, and when you're 55, you will thank me for bringing this up. Okay, huge and, mind you, exclusive tax benefits. We'll see that in the next slide. Okay, stupidly low fund management fees for the funds that you're saving. It is 1 bip, excuse me, 1 bip. Equity mutual funds charge you 200 plus bips for most equity funds, right? This is 1 bip, 1/200th of the asset management fee. And up to 75% of the money that you save here can be put into an equity fund, right? It's tax efficient, even in terms of the maturity outcome. So at age 60, 60% of your accumulated savings plus returns, you can just pull out in a lump sum, tax free completely, 60% of it. Not all, but that's fine. Okay. By the way, partial withdrawals of up to 25% of the voluntary contribution bit are also exempt. That's fine print. Don't worry too much about it. Okay. But the remaining 40%, just for those people who are saying, okay, so what happens to the remaining 40%? So at age 60, if you have your corpus as 100 rupees, you get 60 rupees in hand, zero taxes. And the remaining 40% is put into an annuity, which you can get for as long as you're alive. And once you die, then your spouse gets that 40% as well as a lump sum. So beat that, boss. This is the best tax saving. So you were saying there is no social security available. Well, there is a social, in India, there is a social security financial instrument of possibly the best quality and best return profile, the best tax saving profile in the world. We may not have government funded old age support, pension, healthcare, etc. But the government has given you this financial product. And I think you should make full use of that. By the way, even the returns, last 5-year returns have been about 7-8% for the Nifty. I think this was, Pratibha, this was made when the Nifty was 11,500 or something. We've done a little better than that on the Nifty, but I'm sure the equity funds within PPA, within NPFs have also done equally well. It actually beat the Nifty over the last 5 years when this calculation was done. In fact, the corporate bond fund, hold your breath, just because interest rates were falling, government and corporate bond funds inside of the NPS give staggering returns of 9%, 9.5%, 10%. I mean, this looks crazy. And we haven't even gotten to the tax benefit the exclusivity of the tax benefit. Let's take a quick look at that, Vijay. Yeah, so this is the crazy slide that is going to change, that is going to make eyes pop out. Okay, so you thought that you were exhausting your 1.5 lakhs contribution, and what other way there is to save taxes? No other instrument gives you a headroom over the 1.5 lakhs for a savings product. So you can put in another 50,000 rupee voluntary contribution. There is no limit on your own contribution, but up to that 50,000, you will get the tax benefit. Okay, this is the 1-star observation here. The 2-star observation is far more valuable. You can tell your employer, deduct money from my salary for December, January, February, and March. How much? Okay, so you can get a tax deduction beyond 2 lakh rupees also by using section 80CCD2, such that you avail of a tax benefit on for tax exemption all the way up to 7.5 lakhs. So remember, you were at 1.5, you took it to 2, another 5.5 lakhs of room is available to you. And much of that can be filled in with NPS, because your superannuation, if it is there, will be low. And the employer contribution to EPF is probably exhausted in that 1.5 lakhs anyway. So theoretically, you could have another 5.5 lakhs of additional savings, which will give you, let's say, 30% cut on your tax outgo. Vijay, this sounds stupidly good here.
I'll tell you the background to this, right? So this was started, the fundamental thought process was done by Sri Atal Bihari Vajpayee, right?
What are you saying?
So yeah,
Wow.
actually it was his thought process, where he said the same point of view, that social security was very low. Somehow it didn't come through it, but in 2004, when this was launched, this NPS is actually governed by the Pension Fund Regulatory Development Authority. Like you have for insurance, which is IRDA, you have a PFRDA for NPS.
Right.
So those it is regulated by it from that standpoint. And over the last few years, they have been pushing people to invest here by enhancing the limits. So you talked about 50%, 75% equity share. That was changed recently, 3 to 4 years back, because they wanted more exposure for people, so that the investments are giving you more returns, and all of it is to a large extent tax exempt. This is in my view, this is the best tax saving instrument that you have across all, with the returns that it is giving you. So the point that you showed in your previous slide, where the equity is just about 7 to 8%, if you look at right from 2004, right, let me hold your breath, the average return is 12.5 to 13% only on a blended basis. The equity return will anywhere be 15-16%. Right. So if you held a NPS account right from 2004, you would have created enough wealth already.
And I would have done better than the average stock market punting that I do all the time. I mean, this is stupid.
Obviously.
This was passive money. This is lazy investing at its best.
And this is what I want to call, the first point that I made about Chanakya, right? This is a clear validation for investing to the future, right? What are you doing for yourself when you are unwell, when you are having a retirement? You don't want to be some, old man who's sitting on his chair and waiting for his children to take care of you. Rather, you should be somebody whom they want you to accompany, so that you are the rich old man in the house, right? So all those grandsons vying for investment should be coming over to you. This is something that you can help to get that.
Fantastic, fantastic. This 2-star row in the middle is a complete game changer, and this is not available in any other instrument. This
Correct.
is,
and I just want to let all my employees know, or whoever is listening to this, if you have not enrolled to NPS, please do it today. It gives you a tax benefit beyond the 1.5 lakhs in ATC. It gives you 2 lakhs, beyond the 2 lakhs, you can invest 10% of your salary into NPS. Now, there is also a regulation that is being sought for increasing the level of basic salary in your overall salary. They're saying 50% of your salary should be NPS, rather basic. So actually 10% of the 50%, almost 5% of your salary, you can put it into NPS. I think if you have not done it, please redraw your investments back into NPS. This is giving you returns like nothing else.
Fantastic, fantastic. Okay, what else? So you also have, I think this bit is missing, Pratibha. Or no, there it comes. So there's a little bit of animation. Okay, so you do have tax benefits on, liquidation actually, or maturity, not liquidity. That's the wrong word here, but never mind. And then 20% on a premature exit. So there are finer details in this game, and they can be figured out. But the big deal here is, and of course, 60% of the maturity withdrawal is tax-free. Unlike 25% of partial withdrawals, or if 20% on premature exit. So if you hold it all the way till 60, then age 60, then 60% is completely tax-free, and you get it as a lump sum. And by the way, even the remaining 40%, which is the purchase price, as it is called at the time of purchasing the annuity, that purchase price goes to your spouse in case of your death. That is also that is going to go back to your spouse. So that money remains with you. It is tax free. I think this is clearly the most staggering and powerful and most loaded tax hacking instrument.
I'll tell you a simple math to go with this, right? I mean, all those slides may not set the math on your mind, but if you go to the NPS website, right, the National Pension Scheme website, where you actually refer to a permanent retirement account number, the PRAN that they refer to, that particular website has so much of detail in terms of this, how this is covered and so on, right? In fact, I was intrigued to understand they have mathematical samples, right? I'll tell you a very simple analogy what they've given. So if you are an employee who can put 9,000 rupees in NPS, right, every month, and if you are 30, right, at a 10% return, right, you would have actually created a corpus of 1 crore by the time you are 60. Right? Okay, so 30 years you have created a corpus of 1 crore. And the compounding effect. So look at this. You have invested only 33 lakhs, but in 30 years you're sitting on a corpus of 1 crore.
Wow.
Right? And if you get, let's say, 50% of that is something that you want to withdraw, that is completely tax free. Right?
60% actually. You can go all the way up to 60%.
So you can go up the way. So let's say I'm saying, okay, I only want 50 lakhs. So I set aside 50 lakhs, keep that with me, which is completely tax free. The balance 50 lakhs, if I invest into a scheme, which is, let's say, a normal kind of a thing, right? It actually, sorry, my number is actually creates 2 crores. 33 lakhs creates 2 crores over 30 years, right? So you can set aside 1 crore, balance 1 crore you want to buy an annuity, right? The first scheme that you mentioned, where it actually could give you just a monthly pension. Can you imagine what is the pension you will get? You will get a pension of 73,000 rupees.
With that 1 crore investment.
With that 1 crore investment, right?
So you're getting something like 8.5% on the annuity, and that 1 crore goes to your spouse after you have.
Exactly, and not only that, you can actually have a scheme where the lump sum also anyway goes back to your spouse. The monthly payment also goes back to your spouse. There is a scheme where even after your spouse dies, that corpus can come back to your children also. Right, so there are multiple schemes within that. So
there are multiple options on how you structure the annuity. Yes,
and it's really material, right? If you want to have something that is important, there is no other option but to go for an NPS. That should be your first scheme. After EPF, PPF, whichever company is deducting, mandatorily, rest of it should be through this.
I think we're going to run out of time for questions. But Pratibha, I think I will take the liberty of doing a little bit of a business pitch for my firm. You might think, okay, so it's good to do this. It's good to save taxes. Okay, so I think I should do it through NPS, and this is a great way to hack my taxes. Well, you can do all of that at HDFC Securities, let me tell you. In fact, all asset classes and investment products, anything to do with savings and investing, whether it's equity, debt, mutual funds, commodities, currency, insurance, health insurance, life insurance, general insurance, global investing, you can invest in US stocks, and of course NPS. All kinds of bonds, government bonds, SGBs, everything. 360-degree investment view. Your savings, financial planning solutions are available. All you need to do is you can, and of course you can do tax savings on NPS. You can open your account digitally at hdfcsec.com, create your investment account for all the other instruments also at hdfcsec.com. More than happy to help you through this journey. Happy to serve you. Questions?
All right. So, yeah, we have a question from Ronak Agarwal. He asked, Which of these are tax deductible under the new tax regime 2? EPF, PPF, NPS, medical insurance.
Okay, Vijay, this is a googly, and I think I should let you take it.
Yeah, so if you look at it, the new tax regime is talking about, so you can take a benefit of EPF, but the rest of it, NPS also is deductible, but the rest of it, no. So you can't take a housing loan, you can't take a HRA, you can't take many of those things which are not allowed.
Yeah. So you just need to go through the fine print and see. So there's very, very limited tax deductions available in the new regime, and which is why I want to play test cricket. Next question.
Shivam Saxena is asking, how is the calculation made for the 1.5 lakhs ATC exemption? Is it flat 1.5 lakh rebate or some percentage proportion for what we invest?
So there are 7-8 categories where this aggregates to the 1.5 lakhs. There are sub-limits in each of those, right? But for example, your PF that is deducted by your employer also can be limited into the ATC, but there is no limit on how much of it should be, PF. There are some categories, let's say, for example, if there is a insurance premium you're paying, again, that is not limited. So there are some categories where there is a limitation and some there is no limitation. End of the day, all of it has to compile to the 1.5 lakhs.
Yeah,
So
and if it all adds up to more than 1.5, then you're really not saving the tax corresponding to that investment
Correct.
or that payout, which is why NPS becomes so relevant. You can raise that 1.5 to 2, and you can drag the 2 to 7.5, and it's the only bullet that allows you to do all this.
Correct.
Okay, Pratibha.
Right. We have our own boy from CISCO, Bhushan Narkhare. He's asking, I have joined CISCO in August just after my BA. As I didn't have any investments, so opted for new tax regime in the company. But now I'm thinking making investments. Can I file return in old tax regime?
So I'm not sure whether we could hear you clearly, Pratibha. You'll have to try this again,
I'll
or maybe
repeat once again.
Yeah, now your voice is better.
Yeah, so Bhushan is asking, I have joined CISCO in August just after my BTech. As I didn't have any investment, so I opted for the new tax regime in the company payroll. But now I'm thinking of making investments. So can I file return in old tax regime?
No, actually, it's a call that you have to take at the time of filing your, from a tax deduction standpoint. So if you want to shift now, you have to pay your taxes again, realign the investments point of view, and there may be a kind of interest that you will need to pay, right? But you can still go back and file with the old tax regime.
So there is a way to do it. It might involve a payout and a little bit of a penal interest or something on delayed payments, given the new tax regime calculations. Okay, fine. So it's a hardcore nuts and bolts question, and you should figure out the answer. I'm sure Vijay will help him out. All right, Pratibha.
Yes, we have a couple of few questions more.
Yes.
Question from Shivam Saxena. Which is better, PPF or VPF?
It's like choosing between what should I say, honey and green tea. They're both useful. They both have their virtues. The more you have of both, the better it is going to be for you. I mean, I would recommend both. Why? It's not one or the other, right? They needn't be mutually exclusive. I'm saying even if you exhaust your savings limits under ATC, put all the money you can 1.5 lakhs a year to put under PPF, irrespective of what is happening in employee provident fund. You should do that. For God's sake, nobody gives you 7% compounding every year today, tax free. No government in the world is doing that.
And also in terms of the window, right? Both are long term. If you're looking at actually creating some sort of a kitty or a pot for, let's say, supporting your children's education or whatever. So I think you set aside a PPF account so that you can keep putting in money there in his name. End of the
Right.
day, year, 15 years, you can use that money. VPF is more for from a retirement kind of a thing. So it's like it adds to your PF purpose. So the interest rates today are more favorable for PF, but the withdrawal and all those mechanisms are easier for PPF. Right? End of the day, it's still long term and it depends on your goal and horizon.
Fair point. Next question, Pratibha.
Okay, good.
One last question. Are we?
Question from Santosh Nair. A couple of them more, please. Yeah.
Sure.
Question from Santosh Nair. How liquid are these sovereign gold bonds?
Okay. So sovereign gold bonds are tradable in secondary market, right? Like I said, they generally trade at, let's say, 5 to 10%. Maybe now because the gold demand has gone up 2 to 3% lower than their market price. From a liquidity standpoint, I don't suggest, if you need money for short term, to invest into SGBs, because the benefit of SGBs are always long term, right? The capital gain benefit that you get is long term. The appreciation benefit is also long term. So essentially, you will not get great benefit over maybe a couple of years in gold. So from a liquidity standpoint, I don't recommend, if you have a shorter sight on requirement of funds, don't go for SGBs.
Okay, actually, my view here is that the SGB discount is actually the price that short-term guys are paying the long-term guys.
Exactly.
The long-term guys are being paid that money because somebody needs that money in desperation and is willing to sell at a discount. So the more desperation there is in the market, the more is the spread that you will see. When you see the spread hits your sweet spot, if it's 7 or 8 or 10%, go ahead and buy, and then have a long-term attitude. The minute you have a long-term attitude, you're on the receiving end of that discount. Everything good seems to be long-term.
Yeah, and the beauty is, if you do this to a Demat account, you get 50 rupees discount, right? So for every gram of gold.
Fabulous. Okay, Pratibha, one
So
last
with
question.
this, I come to the last question. Yes. Question from Krish. He is requesting for a comparison NPS versus PPF. In terms of minimum investment per year and locking period, I think both are EE.
Okay, Pratibha, I think your audio is gone for a toss, and that's because you probably have a poor connection. What you should do is you should switch off your video and then try using the audio. Maybe that will conserve bandwidth at your end. Let's give it one more shot. Okay.
Am I audible?
Yes.
Yes, you are.
Yeah. So Krish is asking, comparison NPS versus PPF in terms of minimum investment per year and lock-in period, because he thinks that it's EEE, so he would want to have more clarity on which.
Okay, so the sensible answer, sorry, you want to say something, Vijay?
No, go ahead if you want to just frame it.
The sensible answer is, again, they are not mutually exclusive. It's not that one is better or worse than the other. PPF gives you a 15-year savings horizon, which can be extended by 5 years at a time. NPS is, well, 60 minus your age. That's the X number of years for which you are going to be able to use NPS, but you don't have a choice in terms of changing that. So if you're 35 years old, then NPS is available to you for the next 25 years. PPF, irrespective of the age you start, is available in installments of 15 years and then extendable by 5 years at a time. So if you're starting really early in life, I mean, I'm saying do both. It's never a late, it's never a bad time to start both of them together. If you've done one, do the other. It doesn't matter which one is which. And if you really want to compare, I think the extra headroom that is there in NPS to save taxes technically makes it superior to PPF only to that extent. But that's a large extent because you're dragging up your tax exemption by another 6 lakhs or so. So that's about 2 lakhs of annual savings. And then that's compounded over a long term. So if you're 25 or 30 years old today, you can imagine what kind of compounding benefit that can have, that 2 lakhs of extra savings in tax outgoes that you are doing. I think both of them incentivize you to be a miser.
I think, analogy of cricket. So it's a 5-day test match, right? So 5-day test match is an NPS where you're looking at a retirement, and the objective is more to take care of yourself and your kith and kin, your family, when you don't have the capacity to earn anymore. Whereas PPF is like in a session, in a day, there are 3 sessions in the test match, right? So in one day, so maybe first 15 years you want to save for your child's education, next 15 years you want to save for, let's say, buying a second house, those kind of stuff. So it's a smaller time period from a horizon standpoint, but NPS can give you, so a PPF can give you only fixed return. That's also fixed by the government. It's about 7.1% at this time, but NPS can magnify that return. So for example, like I said, Pratibha was sharing with me, the average returns over the last 5 years has been anywhere between 12 to 13% with HDFC, right? So that kind of return you don't get in PPF. If you want to maximize your wealth, and today you are saving tax, that itself is a notional return for you. And on top of that, you are getting 12 to 13%, which is also because your share of equity is higher in that base. So I think NPS is a different, it's like a 5-day test match, and this is more like sessions within a test day.
Great. NPS is actually when you want to bat for 2 whole days and become the star batsman who scores 300 not out. Wow, wow.
And wins the test match.
What a beautiful analogy. I think that's a superb way to end today's session. I think this cricketing analogy is something that we will persist with in our future endeavors to educate people on savings products and tax savings products in particular. And to be able to use the one-day analogy, the test analogy, the 2020 analogy, and even the sessions analogy across the times of the day. Wow. Vijay, if you were an advisor, you would have qualified for a fee today. Is all I can.
No, I think I am very honored. In fact, these are fundamental things which everybody should imbibe, right? And I'm very happy to have been able to share my point of view. And thanks Dipen, thanks Pratibha, thanks HDFC for having me here.
Hats off to you, sir. Thanks very much. We will be forever grateful for this amazing session. We had great fun, I can tell you. As a cricket lover and a certified miser, I think you've added value to both parts of my personality. Thank you and bye.
Thank you. We'll stay in touch. Thanks.